Hello, everyone, and welcome back. My name is Greg Furman, and this is the VantagePoint AI Market Outlook for the week of October the 4th, 2021. Now, to get started this week, we're going to begin where we always do with that very important US dollar index. But first of all, let's have a look at some of the markets we're looking at for this coming week and the indicators being used in this particular presentation. So some of the markets we'll be looking at today: US Canada, British pound, US dollar, Euro US, dollar yen, US Swiss franc, light sweet crude oil, our main equities, the S&P 500, the dollar index, of course, gold, Ethereum, Aussie, US, New Zealand, US, and Bitcoin. Now, we'll look at some of these, maybe not all of them, but we'll get through a few of them. Now, first and foremost, we want to look at the dollar index. An upcoming event risk this week, of course, will be the non-farm payroll number. In my respectful opinion only, this could be a make or break area for the dollar here. Now, when we look at the dollar, you can see that we've put a top in place at or about 94.43. Now, again, the indicators being used here, the 52-week look back, we're using bars, not candles. The predicted short, medium, and long-term difference, very important neural index, point in time or point in time price, triple cross, and of course, the very popular verified support and resistance zones. Now, when we look at this in a 3-month period or in a custom shorter period, we see one view. But when we back this out and we look at it over a 2-year period, we really do get a very clear picture of where the dollar has been and where it currently resides. Now, this major resistance here, 94.30 and 94.74. This has contained the dollar on the upside for approximately the last basically year and a half. So we're hitting this high up near this particular area, but we're unable to get above it. The low area of this particular channel is coming in at or about 89.32. So this is the structure of what we're looking at. But the verified resistance right now, at least at the 94.40, is holding. But again, in my respectful opinion, this payroll number will be a determining factor. The Fed has pushed the dollar higher. It hasn't got up here on its own merits. Basically, the Fed talking up that they're going to be looking at raising rates earlier, which is prompting the dollar to extend higher, but very minimal. So when we look at the current structure of where this market is at, you can see in the point in time using the weekly opening price, the dollar is held above the weekly opening price, but we've put this high in place. Now we have 2 bars to the left and 2 bars to the right that are lower than this highest point. That has triggered our neural index to turn down. Now, when we look at our MA diff cross, which measures the strength of that medium-term crossover, which I'll illustrate here by clicking on the F7. Now, the crossover point is highly accurate. We've moved higher, but at this point, right on this particular bar, at this high of 93.45, this triggered and started to show that the strength of the dollar may not be as strong as what we think it is. And again, this is a highly accurate indicator. Now, the neural index is in agreement on this. But again, when we look at this move, a lot of this is being caused by the Fed testimony. But it is still, the dollar index is still, or the dollar itself is a fiat currency. With the printing presses, they're going to be producing, I think, another $4 or $5 trillion in debt that they're going to have to cover. They've raised the debt ceiling, so that's passed. But now the payroll number, the Fed is going to be watching this payroll number on Friday very, very closely. And what he's looking for is to see if the labor market is really starting to strengthen. The average hourly earnings are up, the U6 being down. So they're going to be measuring this. So again, a very, very important risk. But that Fed announcement is likely going to determine this. Now, what I've talked about in the past many, many times is there's a cycle of dollar buying around the beginning of the month. So we would have to make the determination here, is this just part of the normal monthly cycle where the dollar is strong at the beginning of the month anyway, and then it sells off on the Tuesday or the Wednesday after the non-farm payroll number? That is still a realistic outcome. That is one potential outcome. The other outcome is that the payroll number is a blowout number of 900 or over 1 million jobs. Unemployment rate goes lower. Everything the Fed is looking for is met, and then that triggers the market into thinking the Fed is going to raise rates sooner rather than later, and that should strengthen the dollar. But again, this is very formidable resistance. When we look back at these seasonalities over that 2-year period, we can see that the dollar is sold off in each one of those years by November the 5th, with money moving offshore to avoid or minimize their taxes that they have to pay, only to bring that money back in January, where we always see the dollar strengthen from usually January till about March 30th or so. Almost every calendar year we see this. So I don't think that this year is really that much different. I think that the dollar is recovering from this mess that COVID has caused. But again, we will see. The main thing is that we know our levels and we look at the immediate vantage point forecast. So again, the neural index is picking up on weakness in the dollar. We have a high point where we failed, and the MA diff cross has still to date has not, the pink line has not crossed the blue line back to the upside. They're actually starting to slope downward again. So this is a warning sign, if nothing else, to be very, very cautious buying dollars up at these extremely lofty levels. Now, when we do a comparative analysis from the dollar to gold, then we can further assess here that gold is trying to recover here. So we're looking at gold making a potential move here. Now, when we look at it from the triple EMA cross, again, using the Vantage Point predicted moving averages as pivot levels are very important. Now, gold has had a substantial recovery from Wednesday, that big move up on the dollar. And really, when you look closer at the dollar chart, most of the gains in the week were on Wednesday with that Fed testimony. So gold basically shrugging that off. We've had a good rally off that verified support low. But now we're getting tangled up in the T-cross long itself at 1749. This is, or excuse me, 1760.84, the T-cross long. So again, we would look for the market to break above this, but I think that that's a somewhat unlikely in the week of the non-farm payroll number, because we know that we've got dollar demand. Now, if we can clear 1760, that should take some of the pressure off the downside in gold. Again, we are not making any new lower low here, which suggests that gold can recover with some of the other commodities. So we'll be watching that one very, very closely. But again, if we click on our F8, one of the ways to really get the most use out of the VantagePoint software with a minimal amount of lag is to actually remove the black line, use the blue line by itself. We've closed above this blue line 2 days in a row. Now again, you can see 2 days in a row when we closed below it here, that led to a substantial move lower. But now we've closed 2 days above that blue line, which suggests that there may still be some life in gold. Our neural index, has been up for the last 2 or 3 days in a row, and our predicted differences are pointing up, suggesting that gold is still recovering. But again, be very cautious with gold in the week of the non-farm payroll number. Now, with stocks, again, stocks stalling at a known level here, 43.05, the verified support low. Very strong buying off this on Friday. Probably we're getting close to the global equity markets turning around and going back to the upside, but some caution is required here. Now, again, with the dollar strength, in most cases, that pushes equity markets lower on that dollar strength. So if the dollar reverses here, which I'm not convinced will be next week, I think it'll just stabilize. But again, if the dollar does break out and it triggers or the non-farm payroll number is a big number, then that's going to spook the market, and they're probably going to come out of stocks even more. But if that payroll number is soft, then you can expect stocks to rally significantly, probably back up to the next verified high. That's coming in, that verified high up at that particular level there. We're looking at about the 44.65 mark. But first, we must clear the T-cross long, that level 44.06. But again, if we click on our F8 in the software, you can see using that blue line, the predicted moving average by itself, and using that as a pivot level to buy or sell from, or to straddle that, where we could say, okay, we're expecting this to go higher. So we would put limit orders just above that blue line. And if we can, we would utilize the predicted high and predicted low if they can match. Now, our predicted differences are starting to base out here. So that would tell me that we're getting closer to the equities turning around. And again, September is a known seasonality with stocks, guys. I don't think at this time it should be considered a new trend or stocks are just automatically going to go lower, because September again is a known seasonality. It's very important that we use these seasonalities to our advantage. If we look at this, you can see that last year at this time, stocks did turn back around. And I don't think I have to tell anybody what happened from there. So basically, by the time we hit October the 30th, which again, that seasonality in the US dollar index or the dollar itself selling off at the first week of November, that was your trigger for the S&P rally. So we're probably a few weeks away from a substantial equity rally, but it's still definitely in the cards here. Now, with light sweet crude oil for next week, once again, oil making this fairly decent, fairly strong move up. Now, again, guys, remember that oil was down in this section back here, going back into the earlier part of September, and most of this rally that has happened here is largely because we're on the border of an energy crisis here. China being the more or less the cause of this, telling their people to go out, buy up oil, buy up natural gas, coal, and buy energy right across the board. They're stockpiling. They're getting nervous. That's what's triggering this rally here. So again, we are moving up to the extreme highs here. So once again, we always want to make sure that we're looking at these seasonalities, because again, they're very often commodities, currencies, even some of the global indexes can be very repetitive at certain times of the year, much like what we just saw on the S&P 500. So when we look at that on a year over year basis, it's usually the oil does not take a bigger rally until probably November. But this one is a little conflicted, because remember that we were dealing with, we were dealing with COVID issues. But at this particular time, and I want to dismiss that myth right now, that oil up, dollar down. That has not been the case in 2021 here, guys. Oil and the dollar have been equally strong. They've been largely moving up and down together. You can see that oil had a good week last week, and so did the US dollar. So we don't want to get into that old adage, that pre-COVID notion that just because the dollar's up, oil has to be down, or vice versa, because that's actually not the case. So right now, if we're looking at these types of seasonalities, and if the dollar does sell off, then that doesn't necessarily mean it's going to trigger additional longs on oil. Now, the major, I think, event risk that we're going to be dealing with in oil this week is OPEC on Monday. And OPEC is also responsible for about 75% of this upward move over the last month or so. And again, because they want oil prices higher, they don't want to increase production. They want this, they want that. So we'll see what OPEC has to say tomorrow, but that's going to cause further volatility. But be very, very cautious. Now, with Bitcoin, once again, Bitcoin, the real top, one of the top trades again, buying Bitcoin this past week off of these verified support zones down here in this lower 40,000 mark. Once again, a substantial move, up 20% in just over 20% in just a matter of literally days. And again, these are the kind of moves that we want to look for. So if we look at Bitcoin as to where we are right now, it's quite interesting, actually, if we look at it from a profit calculating basis. Now, I'm not necessarily going to go with 5 showing those kind of numbers, but even if we just go with 1, that's $7,420 buying off these verified support zones. But once again here, guys, thinking outside of the box, what we would look at is we would look at this and say, okay, I've got verified support here and it's strong. Then I have an MA diff cross that's taken place right at this point, which is telling me that the medium-term trend is weakening against the longer-term trend. That led to a substantial rally. The trigger, again, being the MA diff cross. Now, if we click on the F8, you can see we have 2 days in a row that we've crossed this blue line. Now, bear in mind, this bar is actually from today. Coinbase is trading, so it's going to be a little choppy. This is what we need to do, is clear this resistance high at 48,786, and that should take us back in towards the 52,000 mark. But at this particular time, for 2022. It may be a little premature or early, but I always make my Bitcoin forecast, and I'm already putting Bitcoin between 60 and 80,000 next year. Bitcoin largely doubling almost every year for the last 10 years. It's been it has been the number one investment with an average of over 230% annualized returns. So again, be careful who you're listening to with Bitcoin. We want to make sure we're checking our charts, checking our intermarket correlations, and I'll further submit that the dollar strength this past week had absolutely zero effect on Bitcoin. You can see that by Wednesday, Bitcoin had bottomed out, and by Thursday, we were already turning higher. But this is a very small move considering the amount of dollar strength that we actually had. And I could argue to some degree that up until this month, there's largely been a positive correlation between Bitcoin and the US dollar. But to start the week, the long predicted 4409 is the area we want to watch. Now, with our main currency groups looking at the Euro US for next week, once again, we are on our yearly lows here. Right now, you can see that I've got this set at a 37-week look back. So we've recently set a slightly new, like 41 hundredths of a penny lower than the yearly low. But once again here, guys, we always want to make sure that we look at the structure of the market and what it really looks like. So we have a lot of support sitting here at this low end, which is about 116.15. So we're just lingering around this particular area. Now, if gold can recover, that will help the euro, believe it or not. What I've seen is a very high positive correlation between gold and the euro. But for now, we're starting to get a little bit overdone here, but the main key level, our T-cross long, 117.02. The further we move away from this particular number, guys, the more likely it is we're going to retrace to it. The same applies to the long predicted. When we look at that level, we're 116.28. So here's an easy way that you can use your VantagePoint software is you can straddle this blue line. And what I mean by straddling is you can put your sell limit order, stay with the primary trend if you so wish. Then what you'll do is sell this as close to 116.28 as you possibly can. Then we utilize the predicted high. The predicted high is 116.36. So we match the tip of the blue line at 116, again, 116.28 on the long predicted. And then our predicted high is 116.36. So in this particular case, we would have a buy limit order. We would sell, staying with the primary trend, and then have a buy limit order sitting just above 116.36. Or the alternative is you could try and sell 116.36 and then have about a 50 pip stop, or put your stop above the T-cross long. That's a very reasonable play also. Now, again, the euro under substantial pressure. The shipping lines, inflation prices, shortages on just about everything. All of this is affecting the eurozone, and it's affecting the British pound. They're also going into, I believe they have the army guards out there at the gas stations and everything else. So again, this is all playing into those light sweet crude oil prices, the energy stocks. Be very cautious with those, because as soon as this is cleaned up, those are all likely to reverse. So be very, very cautious. But understand right now that the British pound has a very high correlation to light sweet crude oil, just like the Canadian dollar does. So when we look at this right now with the pound, once again, we're hitting down. We've made a new low at 134.12, but there's just no more sellers down here. So it looks like we're going to retrace back up here to the T-cross long. That's coming in at 136.51. Now, the yearly opening price is sitting there also. So to begin the week, what you can also do is, again, use your weekly opening price to gauge the strength in the market. That price is going to come in at about 135.43. If the pound can hold above 135.43, then it has a chance to recover here, but things are not looking that great in the UK. Now, looking at the long predicted, you can see 135.46. We're basically stalling exactly on that level. So another opportunity for a straddle play. If we believe this is going higher, then again, you have two options. You can put a buy limit order just above the long predicted at 135, 46, or if you also, or again, you can sell, stay with the primary trend, sell the predicted high at 136.27, but I feel that's a little higher risk. But you also have the opportunity to buy, because the predicted high and predicted low for Monday, the predicted low coming in at 134.19, and that's right on our new yearly low price. So could be an opportunity there as the medium term and long term predicted difference are starting to rise. Now, another way of gauging true US dollar strength would be the dollar yen would continue to climb. Now, what I've discussed in the VantagePoint Live training room and with my own direct clients is that we have a problem up here, and the dollar yen is an excellent way to gauge dollar strength and what the outcome of that non-farm payroll is going to be. So what I see here is basically a bunch of rats leaving a sinking ship. So when we got up to this level, made a new high, they immediately bailed out of this thing. The medium term is crossing the long-term predicted difference. Now again, this indicator has absolutely zero lag. If we click on the F7, you can see the blue line crossing the black line back here is good, but there's a very wide gap here between them. Now, if we click on the F8 and use the lone predicted moving average by itself, this removes a lot of lag. It allows us to get quicker entry points. It allows us to focus more on how the market is reacting to a key level, combining it with a top that's now in place. So for the dollar to strengthen further, we would look to dollar yen for confirmation of that, and we're not getting it. So one of the other ways that I always like to show this is if we go into the actual details of the market, we can see the top 10 correlated markets to dollar yen, which are likely to fall also if the dollar yen continues to fall. That's commercial metals, inner pipeline, you've got Shaw Communication, Chesapeake Energy. That's another warning for oil. You've got a number of different markets in here. When we look at the inner markets themselves, you can see that this is what the dollar yen looks at for a trade. It looks at gold, light sweet crude oil, the dollar index, the 10-year and 5-year notes, the yen futures, euro futures. This is what the Japanese yen looks at, or the VantagePoint software internally using the neural networks looks at to determine that. So the fact that the neural networks accurately predicted that the dollar yen would not advance on this apparent dollar strength is highly suspect for the dollar rally to continue. It doesn't mean that it won't, but this gives us an idea that it may not, while at the same time pointing us to other trades. Gold, oil, the dollar index, the euro, natural gas, the S&P 500, the Dow Jones Industrial, S&P 500 minis, power shares Qs. These are all the things we look for to guide us as to whether the dollar yen. But the fact that the dollar yen failed, and that's a tell, that could be a tell. If we were playing poker here, guys, I would look at that as a possible tell that my opponent is bluffing, right? So again, this whole presentation is for educational purposes and to provide alternative strategies for you to apply, or to find that needle on the haystack or that little nugget of information that you might be missing, right? So again, keep a very close eye on dollar yen. Now, if this energy crisis continues, then that is likely to be positive for the Canadian dollar, not the US dollar. Now, the CAD is very, very susceptible to any kind of strength or weakness in the commodity sector, oil, gold, some of these things. So right now we have closed below the triple EMA cross. This is one of the best ways to use the VantagePoint predicted high and predicted low. The predicted high is coming in at 126.61. We've got our T-cross long coming in at 126.77. If we click on our F8, then our long predicted is 126.74. That is all consistent and very, very close to the VantagePoint predicted high of the day. So when it rallies up to that level, good, bad, or indifferent, right or wrong, that's used as a trade setup, as an entry point. So all we're doing, and remember, this presentation is on Saturday. The markets are closed. All we're doing is waiting for the market to come up to the level that we want, in order to short this thing. Our predicted differences are below the zero line. Our neural index is down. Everything here is pointing down on the US CAD, but the US CAD needs, again, if we're shorting US CAD, what else would we be doing? We would be buying the S&P 500. We would anticipate that oil is going to go higher. It's not just about the dollar and the dollar index. The CAD will respond accordingly to the commodity sector and more specifically the S&P 500. So this is warning me that we are getting dangerously close to a reversal on stocks here, guys, now that we've got through September. Now, briefly looking at one other currency here, I don't want to go too long in the presentation, but we also have the Aussie currency, and it's showing signs of life also. Now, almost as soon as some of the analysts had said that the Aussie is going to sit down to the 70 level this week, before you know it, it's all the way back up and closing the week at 72.46. But once again, there's just something is wrong down here. We've got the MA diff crossing here. That's back on this support low. That's coming in at 72.20. We've gone again slightly below that by 51/100ths of a penny, which is literally nothing, guys. And now it's starting to recover again. So there, what you want to be very cautious of next week, bear traps, bull traps, all around this payroll number, because very often the market gets ahead of itself when it comes to this Fed. They buy the rumor, they sell the fact. Now, again, if that payroll number is very, very strong, then you are going to see the dollar extend its rally. But if it doesn't, then the market is going to be grossly disappointed. The dollar sells off, stocks go through the roof, gold recovers, and basically a number of these different Forex pairs that we've looked at here today recover from this short bout of dollar strength. So with that said, this is the VantagePoint AI Market Outlook for the week of October the 4th, 2020.